And the first one is Professor John Birge. Professor John Birge is the Jerry W. and Carol Lee Levin Distinguished Service Professors of Operations Management at the University of Chicago Booth School of Business. He's currently serving as the editor-in-chief of one of our flagship journal in informed operational research. So it's a great honor to have Professor John Birge to give a talk. So John, it's your floor now.
Okay, great. Thanks, Ming, and thanks, Leon, for inviting me to talk here. And let me get my screen. Okay, so I'm going to be talking about what happened with supply chains during the COVID-19 pandemic, which we're still going through. And this is joint work with Shnai Aja at George Washington, Xiang Wang, and Jing Wu from CUHK in Hong Kong. And what this focuses on is one of the, I guess we could call it, benefits of COVID-19, that we essentially had a natural experiment in which many parts of the economy were disrupted. It was disrupted in different ways. And what we are trying to exploit is how it was disrupted at different times regionally, and in particular, how China was first affected, particularly in terms of production, by the outbreak of the disease, and how China then recovered while essentially the rest of the world was then affected by the disease and by great reductions in production because of that. And so what we want to do is to use this event, use this obviously terrible event, but to use it to try to understand something about the relationships between firms and supply chains, and how firms are affected not just by, let's say, idiosyncratic problems that a supplier might have, like a supplier fire, for example, that Agostino brought up in talking about our work on a theoretical model. This is going to be more of an empirical view of what happens when there are disruptions in an overall region, so not just by individual firms, but an overall region, and how that might affect firms who have relationships with firms within that region, and how it might affect it for good or for bad. Okay, so that's kind of the broad picture of this. Okay, so I'm going to use credit risk, and in particular, I'll talk about how it's measured in terms of these credit default swap values. But we're going to use credit risk because credit risk is telling us basically something about the health of a firm. How likely is that firm to pay its obligations? That's something akin to how likely is that firm to survive, to get through this pandemic. We're going to focus on US firms, and we're going to see differences in the effects of US firms. Now, US firms we use particularly because they're not in the same region as China, so we're seeing different effects from that. But we have a lot of data on them. So we have a lot of information about the US firms, and we're going to see differences between those who have either suppliers or customers. These are direct relationships within China, and then within these two periods when either China had essentially lockdowns and people not working, and then when the rest of the world had that. So we had the first China experienced this. Then as the outbreak spread to the rest of the world, production was shut down in other parts of the world while it was resuming in China. And we want to see how these relationships affect this risk that firms have in terms of whether they're likely to pay their obligations, but which we can think of as sort of the risks of the firm. Like how likely is it that these events might make this firm cease to exist? I think these observations will or can provide some insight into how risk spreads across geographical boundaries. They're also important for firms who are thinking about whom they might want to extend credit to, whom they might want to extend trade credit to when they're dealing with firms who are coming from different regions. And should they have relationships in different regions, or should they try to concentrate their relationships in a single region? We're going to use what we call, and what we used in a previous paper with Shnayaja, Vlad Babic, and Jing Wu, which we call abnormal CDS. It's essentially the credit default swap value, which I'll explain in a minute. But controlling for things that affect the overall industry and the overall character of the firm. So it's something that's different for this individual firm. So we try to wash out everything that's, let's say, systematic about what's happening in these credit default swaps. And then we'll try to answer these questions. When the COVID-19 outbreak first happened in China, what was the impact on US firms who had Chinese partners, either suppliers or customers? And then when COVID-19 became global and China was recovering, how was the credit risk of these firms affected? And what characteristics, what things about the firms, like how quickly they turn over their inventory or how much leverage they have, how do those attributes affect the influence of these connections, these global connections during this period? Okay, now to look at the periods a little bit more closely, the first event period is when COVID-19 was breaking out in China. We're going to start it at January 31st. Essentially, that's the day after businesses were shut down in China. There are some others who have used the first day of the Wuhan lockdown, which was January 23rd. We tried some different things for robustness checks, and actually don't find much in terms of difference when we do that. So we'll focus on January 31st. Now for the second period, we want to focus on when businesses start to resume production in China and when COVID starts to hit the rest of the world. So we have February 29 as this date, in particular because that's a date when a lot of businesses in production resumed in China, when there were announcements of resumptions. And it's also the date of the announcement of global travel restrictions to the US. So it appears to be a date that's a likely event when things start to shut down outside of China, but things are resuming within China. Okay, so that gives us these two periods, January 31 to February 28th, and then February 29 will take until April 6th. Okay, now what are we using in this study? We're using the credit default swap market. So if you're not familiar with CDS or credit default swap, it's essentially like an insurance contract. It's a credit derivative And there's someone who's selling protection, who's basically saying, I'll pay you if this firm ever doesn't meet its obligations, if it defaults. And then there's a protection buyer who says, okay, I would like to have some protection. For example, maybe I have lent money, or maybe it's trade credit, but I've lent it to this other firm, and I would like some protection against that firm defaulting that. And the buyer pays a premium, and that's what these markets are tracking. It's the value of that premium or spread. So it's called the credit default spread. And it's periodically paid. It's stated in sort of the annual percentage rate that you're paying on whatever the amount that is due from the obligor, in this case, the person who has taken out a loan. And you pay that whenever the obligor keeps on paying. So there's no default, there's no credit event. The obligor, and the obligors, in our case, these are all publicly listed companies, but the obligor could be a government, it could be a state government, for example, in the United States, or the federal government of the United States. It could be a private company, and so these CDSs are written on anyone who basically borrows money and for whom there's interest in protection against it. If a credit event does occur, then the protection seller, the one who's basically selling this policy, agrees to pay the protection buyer the amount of the lost payments from the obligor. And there's an institution that's set up for derivatives, which makes in a timely manner an evaluation of what the loss was, that the event occurred, and what the loss was, and then there's a settlement that everyone agrees for, and which the protection seller pays. Okay, so why do CDSs matter? There's a lot of money that's involved in terms of CDSs. It's not as much as there was before 2008, 2009, which is when we had the financial crisis, partly because these CDSs were involved in that. But it's still, as of the end of 2020, was around $8 trillion notional amount. So that's a fairly large amount, little less than half of the US economy. It responds quite quickly. What we find is that a lot of people have done these studies of this CDS market, find that the CDS values respond very quickly to any kind of events. And it responds a lot faster than credit ratings, which come from the ratings agencies. It has been shown to be a major driver of that 2008-2009 crisis, as I said. And a lot of companies pay attention to it, particularly chief financial officers. They certainly are aware of their CDS values. That is how the markets are perceiving their risk, as well as the risk of their supply chain partners. It also reveals how credit risk can move like a contagion through the economy. And there's been a number of papers which have looked at that as well. Okay, so here's the big picture. This is just showing you in this diagram the effect of these two periods. So I have a timeline going across here. And here's our beginning period. This is January 31. And what you see are the abnormal credit default spreads for firms in the US that have Chinese suppliers. Those are these dark boxes. And these are the gray boxes for firms with Chinese customers. And the X's are the firms that do not have Chinese customers. The values going up means they've become more risky. So firms became who had these Chinese suppliers and customers, both suppliers and customers. In fact, customers having a somewhat greater effect than the suppliers. But both firms with both Chinese suppliers and customers have higher of these abnormal, that is relative to their base, higher CDS spreads during that early period. And now if we go to the second period, which starts over here, here's February 29. So here's the early period. Looks like there was a lull in the middle, but then it went back up again. And then if we go to February 29, it seems that things start to settle down, but now the rest of the world is starting to shut down. And as the rest of the world shuts down, now the firms that don't have Chinese suppliers, their risk is going up. And the firms that do have Chinese suppliers and customers, the firms that have Chinese supply chain partners, their credit risk goes down substantially. And in fact, it goes down even more than the amount that it went up by during that earlier period. Okay, so that's the big picture. That firms with these supply chain connections to China, first, they became riskier, according to the market. And then, as China starts to open up and the rest of the world is starting to shut down, those firms that have those Chinese connections suddenly become less risky. Okay, so let's try to do this a little more systematically to look at it with some statistical precision. And let's use, and I'll talk about the data sources that we'll use. So we use this data source called Market. It provides end of the day quotes for these credit default swaps. And it has them, as I say, on a large number of corporate obligors or obligators, as well as other entities, as I say, anyone who issues any kind of obligation that people would like to have insured can have credit default swaps placed on them. For the supply chain structure, we use the FactSet Revere supply chain data, which shows connections between firms. In this case, we had about 1,400 US firms, and has their connections to suppliers and customers throughout the world. We also have attributes about the firms, that those come from FactSet. As I said, we have these supply chains that come from, or those come from CompuStat. We have the supply chains that come from FactSet. And then we have a number of other attributes, which we take from the papers that you see here. Okay, so just to tell you what that abnormal CDS spread is, we take the actual CDS spread of each of these firms on each of these days, and then we subtract off the value of an equally weighted CDS for a portfolio of firms that have the same rating as the firm that we're focusing on. So in other words, it's sort of saying, let's look at some of the similar firms to this. And if it's something that's sort of going around the market that we think, oh, everything's risky or everything's not risky on this particular day, we think that's going to affect all of the firms that are in this credit rating category about the same. And so it's the difference between that overall average and the CDS spread of the focal company that we're actually measuring. And we'll do the exposure to China in a couple of different ways. We'll either do it through a dummy variable that just says it's 1 if a firm has a Chinese supplier or a customer, a Chinese customer. And then we'll do it with the number of these relationships that these firms have. And then we'll also indicate the period. So we have the period if it's either in that first phase between January 31 and February 29, or if it's in that period between February 29 and April 6. Okay, this is just giving you some overall summary statistics. In general, these credit default swap spreads are relatively small. The mean is only about 2% per year, which is about what happens with these firms, about 2% per year default, which is what you would expect. So that's what you're paying. You're paying for that 2%. But for those firms that are not very risky, at the 10th percentile, it's only 0.3% or 30 basis points. For those that are at the top, it's more like double the average. And you see the number of connections. Most firms do not have Chinese customers or suppliers. So it's usually like the 10% who have Chinese customers, about 25 or 30% who have Chinese suppliers, and the number of links, again, not too many. So most of the firms are in this sample are not necessarily connected to China, but otherwise the sample is sort of representative of all firms. Okay, so our first set of results I'm going to show you is what I'll call our baseline regression model. So we'll just look at regressing this abnormal spread, and then if a firm was exposed to a Chinese supplier customer, and then we also take out firm and day, industry day fixed effects. And we do it both whether they were exposed and how many partners they have. And then we'll do it both in the first period and the second period, and then we'll also test them together and see what the overall effects are. Well, you saw that diagram that I showed before, and these are basically the results that confirm what your eyes told you in looking at that diagram. If we look at the first period, the abnormal CDS for those firms that are exposed to Chinese suppliers is significantly positive. If they're exposed to Chinese customers, it is also significantly positive. If we do it with a number of links, the same thing, it's significantly positive. If we do it for customers as well, it's significantly positive. If we look at the second period, it is significantly negative. And as I said, if you look at the magnitude of these two results, look that it's even more negative during that second phase than it was positive in the first phase. And the same thing is true for looking at the number of links, for suppliers, or for customers. And when we put the two together, we get positives for the first period, negative for the second period, whether we do exposure or number of links, and whether we do suppliers or customers. Okay, so those are the basic results. Let's look a little bit at what also might be happening. First, I'll mention what this means in terms of the overall change to these credit default swap values, these CDS values. What it means is if you moved, let's say, the number of links from the 50th percentile to the 70th percentile, in the first period, you would be paying another 10 basis points, 0.1%, for these credit default swaps. And in the second period, you'd be paying 13 basis points less than the other firms that are in this group. for those that have these Chinese suppliers. And if we do it on the customer side, it's a little bit more significant in terms of the economics. In other words, 14 basis points during up, more risky during that first period, and then 20 basis points down during the second period. So fairly clearly, the first period, US firms with supply chain links to China, they had increased credit risk. And in the second period, when China was opening, their credit risk went down. And as I said, overall, it's a fairly significant difference overall in terms of they improved more during the second period than they were hurt during the first period. So you could say, well, if I have this Chinese exposure, it might mean that I'm exposed to more risk, but that might be really good when there's risk elsewhere in the world. And in fact, that benefit might be even greater than the additional risk that I'm exposed to. And that's what these results seem to say. Okay, now we do a number of things to check these results. One that we do is we say, well, suppose we just sort of randomly pick out firms and see whether we get significant results. And this is a placebo test. If we randomly pick out those firms, no, we don't see anything significant. And now let's think about what is it that might make this worse or might make it better. So let's think about the effects that might either amplify or intensify the risk, and those that might moderate the risk, might make the risk seem lower than it would be otherwise. So we're going to do the same kind of regression, and then we'll have lots of these sort of triple effects here. We have what characteristics in the firm, whether they're exposed to a Chinese supply chain partner, and in what period the effect might occur. Okay, so let's look at that here. Now, this is the first slide that I'm going to show you is on Chinese suppliers, and then I'll show it for Chinese customers. And what we see is, at least for things that are significant, if firms were exposed to Chinese suppliers, if they were investment grade firms, well, that was significantly less of an effect than firms that weren't investment grade. So if, in other words, if you're investment grade, that means you're able to borrow money essentially on the bond market. You have a credit rating that's high enough that people will buy your bonds as investments. So that means you have very low risk of default. So these firms already have very low risk. They're not as affected by the events in China as other firms. We see a little bit that's significant, but it's more significant when we look at the number of links to Chinese suppliers, but a little bit that's significant whether you're exposed or not. In terms of R&D, so if you're a firm that makes a lot of R&D investments, which is mostly things like growth firms, then you were not as affected. So those firms that were making R&D kinds of investments that are growing, they were not as affected. So that also seems to make sense. It seems like those firms, because they're not as sensitive to, let's say, current events, because they're sort of focused on the future in terms of growth, that they're not as affected as others. Now, in the second period, we see many that were statistically significant. As I said, the overall effect was greater in the second period. So we might expect in the second period that we'd see more things that are statistically significant. What we find is, now in this case, when you see a negative, that means it's not, that means it's even more beneficial in that second stage than the average firm. So firms that have larger size are having their credit get even better in that second stage. Firms that have higher leverage, well, these are firms that maybe they're actually, they have risk because they have a lot of leverage, they have debt. And therefore, it's even more beneficial to them to have these Chinese connections in that second period. If they have a large amount of inventory, it's even more beneficial for them in that second period. However, if they have a lot of cash, it turns out that, well, cash is a moderating factor. If firms have a lot of cash, it probably means they're not so dependent on their suppliers or customers because they have a lot of cash anyway. And as we saw before, the investment grade is also a moderating effect. R&D is also a moderating effect in this case. In this case, Tobin's Q, which is another measure of growth, is not as significant. This is expected default frequency. How likely they are to actually default is not as significant an effect in that second period. How long they've had the relationship? Well, it turns out if you've had the relationship for a long time, that's even better for you. If you're further upstream, it's better for you. But if you are connected a lot, so you're more central in the network, so you have many, many connections all over the world, then it's not as big a deal for you. So if you have lots of global connections, having these Chinese connections, it's helping, but it's not helping you as much. The same is true if your industry is more concentrated. The more concentrated your industry is, probably means you have market power. That means you weren't as you did not benefit as much from these Chinese relationships as other firms. If your product was similar to others, however, oh yes, actually you benefit a lot. And if the capital for your firm is what we call redeployable, which is a measure that we took from some other authors. But if your capital is redeployable, oh yes, also there you benefit a lot in that second period by having Chinese suppliers. And then we see, as I said, similar effects for the links. Oh, and this is the same thing for customers. Many of the same relationships hold for customers as hold for the suppliers. There are a few more significant results here in terms of the customers. As I said, the overall customer effect is somewhat larger than the supplier effect. And so we might expect, yeah, to see more things that are significant, but things that basically go in the same direction as what we saw with the suppliers. Okay, so overall from this, we could say large firms with high leverage, industries that have more product competition and more flexible capital, they seem to recover faster in that second period. They're more they benefit more from those Chinese connections in the second period than other firms. And firms with high cash, investment grade, and high growth opportunities, they were affected less from the connections that they had with suppliers or customers in China. we do, I'll show you a little bit with industry just to mention, we do studies and seeing what industries were more affected or less affected. If you were in, this is exposure to Chinese suppliers, if you were in the healthcare industry, you were not as affected in the first period as firms that were in other industries. However, you were in the consumer goods industry, you were affected more, if you were in the healthcare industry, you were more affected than others. In other words, your CSI is going up even more, which somewhat makes sense that we know that healthcare is being affected, even more of an effect there. If you're in the consumer goods industry, it wasn't as big a deal. Primarily, we think this is because we're selling to, if you're in consumer goods, you're still selling within your market. Your market is not as affected as, let's say, the markets in China. And this was for US firms. We saw similar, this is for those who have Chinese suppliers. We see something the opposite in terms of Chinese customers, for firms with Chinese customers, but that is where you're selling into the Chinese market. So here I'm selling to the American market, I'm not as affected. I'm selling to the Chinese market, oh yeah, I'm more affected during that first period. And a little bit of an effect if you're selling to Chinese manufacturers during that first period. Most of these results are similar to what one might expect during that second period. I'll just sort of summarize those here. The results indicate that essentially that consumer goods, that's like the household demand. If you're exposed to household demand in the US during the second period when the US was hit, your credit risk was high. If you're in manufacturing, oil and gas wholesale, during the China recovery in phase 2, your credit risk went down relative to other firms. And overall, if you're in a sector that was related to households, the recovery in China was not sufficient to reduce your credit risk because you're still selling to these households within the US, and they're being affected substantially. In terms of Chinese customers, we see somewhat that sort of similar pattern, except that now that my customers are in China, when that region is hit adversely in that first phase 1, you're going to be hit even worse. But you recover more when China recovers. And we saw a little bit of an effect with the intermediate group, intermediate goods having increased credit risk during the second period there, primarily because we think because those intermediate goods providers are supplying others throughout the world who are now being shut down. Okay, I think I'll just mention that we also looked at the sort of moderating effects of having relationships in different areas of the world, that is the rest of Asia, Europe, and Latin America. Effectively, the things that you might think if you had these other exposures, it was in general moderating. So having other kinds of exposures was generally moderating. The exception was that during phase 1, you had increased credit risk if you had Asian, European suppliers and customers. And again, we think that's probably due to the fact that China is an intermediary supplier. So that is because these Asian and European suppliers were also being affected, by having Chinese suppliers or customers themselves, then you are actually in worse shape. During that second phase, U.S. firms that had increased credit risk if they had suppliers and customers in Europe and Latin America, but reduced credit risk for suppliers and customers in China. And that's just a natural effect that we would expect to see, that the rest of the world basically was shutting down simultaneously. And so having those exposures in Europe and Latin America during a time when Europe and Latin America were also being affected, that was going to increase your credit risk, and that makes a lot of sense. There's another robustness check we did, which was to try different ways of looking at these CDS values, to try different dates, to try ways in which we put the suppliers and customers together in different batches. All of those end up with the same sort of results. The overall takeaways from this, creditworthiness is affected by regional issues, not just by individual firm disruptions. So we've seen a lot in the operations world, at least, looking at individual firm disruptions, a supplier or customer, those disruptions definitely can affect you, and we would expect that that's going to affect your creditworthiness. But this says that regional issues actually matter as well. That's important if you're thinking about extending trade credit to a supply chain partner. You have to think about their creditworthiness may depend on where their supply chain connections are. So you need to consider not just your own credit, but the credit of those that you're dealing with. That positive impact during the second phase, that indicates an advantage for diversification. And the fact that it's more positive than it was negative during the first phase, that suggests that diversification across regions is a net benefit. Now, it doesn't, this is just in this one example, but it says diversification seems to be beneficial. Okay, so what we did, we used a panel of these links. We examined the credit risk in China. We used those 2 periods. The firms with supply chains in China experience increase in the first period, decrease in the second. There was some either mitigating or aggravating effect from household demand, depending on whether you had Chinese suppliers or, let's say, American customers, or whether you had Chinese customers and American suppliers. So there was an effect from that, particularly if you were selling to consumers. This affected the entire global supply chain. So the world's supply chain was hit by this pandemic, and that magnified credit risk in different ways. And we could see it directly here in terms of these relationships with firms and China. Okay, and with that, I'll stop, and then we'll have some time for questions.
Yeah, so let's open up for questions. Okay, so actually I have a question. So you hinted that the when you compare the exposure to Chinese supplier versus the Chinese customers, there's a stronger effect for the exposure to Chinese customers. I wonder whether that can be explained because we're looking at the supply chains like a pipeline, where the risk on the customer will have more immediate impact on the bottom line of the firm, while the risk on the upstream, the supplier, actually may have a lagged effect and also can be moderated by the inventory, as you mentioned. I wonder whether one can draw that kind of conclusion. Yeah,
well, we saw the same was true with upstreamness. So if you're selling to Chinese consumers, Apple, I'm not sure how Apple was affected, but if you're Apple and you're selling a lot to Chinese consumers, then yeah, that has a direct effect on when they're not buying. That's going to have a direct effect on you, and it's probably felt immediately. So yeah, so I think the fact that you have those customers, when those customers are hurt, that's going to affect your cash flow, so kind of immediately. And if you have any kind of risk at all, having your cash flow affected immediately is no doubt going to have more of a significant effect.
Gotcha. Okay, so we have a question from the chat. So Leanne asked, he felt that the result is affected by firms' anticipation of the potential event taking place in phase 2 after observing the phase 1 outcome.
Yeah, so I mean, that's an interesting question. I'm not sure how to investigate it. Given that China was recovering so quickly, I would say, if anything, people were updating to think, oh, this is going to be over in 2 months, whereas when it's still going on, and certainly went on for months, at least 2 quarters in the United States. So if anything, I would say the expectations were probably less severe than what we actually saw. So, and maybe that's why it took, if I don't know if you remember that chart, but it was actually getting even more pronounced at the end of that period in April. So it seemed to be progressively getting, or those values were progressively diverging as time was going on. So I think people are actually learning throughout March and into April that, oh, this is actually worse than what we might have expected just looking at China.
So I have a question built on that. So it seems to me the underlying assumption of the analysis is the whole market of CDS is very efficient. It can pick up the risk, like trader can pick up the risk they observe immediately and reflect it in the price of the CDS. So I wonder, like, do you think that's the case, or do you think like, is there any arbitrage opportunity, or based on your model, can you find the algorithm that looking for those arbitrage opportunity?
Yeah, in terms of CDS, it seems to be an incredibly efficient market. I mean, there are other, this is not my work, but there have been a number of papers that have looked at the CDS market and have determined that it's more efficient than the stock market. It seems to be very efficient in that it's run by it's run by professionals, whereas the stock market is involves a lot of day traders. We saw that with GameStop and these individual traders. So the CDS market is not as affected by like individual traders, because these are all people whose business it is to price risk, and in general they seem to be quite good at it. So the CDS market seems to be relatively efficient. So very hard, I think, to find. I mean, I would say what happened in 2008, 2009, yeah, you could say there were inefficiencies there, but that was on securitizing CDSs as opposed to the individual name CDSs. And yeah, so that market, because there were a lot of people who were not professionals who were trading in that market, and I think didn't understand the risks that were involved in that market, that had a lot of arbitrage opportunity, but not, I think, the CDS itself.
Gotcha. Yeah. And you also mentioned that the in this case, actually, one of the takeaways that diversification is somewhat beneficial. And by this case, you must mean that the specific, like during the pandemic, China first got hit and then opened up, and then US got hit. But in general, if it is like this pandemic is once every 100 years, usually it would be probably if there's China was like the hub of manufacturing manufacturers and suppliers, then if it was hit, then I guess the risk is going to amplify across the supply chain.
Right. Yeah. So I think this was a very limited case. So if there was something, and yeah, this is saying if there's something that's just totally regional, just only has to do with the region, which, yeah, how can, if it was, somebody discovers that all the Chinese steel has had some defect in it. And so, yeah, Chinese manufacturing, and it's only Chinese steel, but again, it's hard to isolate it. Yeah, this would be something like that, and how that's affected relative to the rest of the world. Whereas, yeah, is the same sort of thing going to happen in the rest of the world that happened in this pandemic? That's not as clear.
Yeah, great. Yeah, thanks, John, for the great talk. Yeah,
okay, thank you.
Work. Thank you.
Man.
Yeah, appreciate it.
Thanks, everyone.